So, Taylor, in our last segment, we discussed holding on to losing stocks, sometimes way past their prime, hoping for a rebound that might never come. It's a tough situation, and many listeners wrote in sharing similar experiences. But today, we're flipping the script and talking about the opposite problem: selling winners too early. We received an email from a listener who's experiencing some serious regret. They bought a stock at $50, watched it climb to $100, and feeling pretty good about themselves, sold it immediately to lock in that profit. Seems like a smart move, right? Well, the story doesn't end there. The stock then doubled again to $200, leaving our listener feeling like they missed out big time. This is a classic example of what behavioral finance calls the disposition effect, covered in our reference article, The Psychology of Investing, specifically in Part 1. Sam, can you unpack this for us a bit?
Sure, Alex. The disposition effect is this tendency we have to sell winning investments too early and hold losing ones too long. It's rooted in the way our brains process gains and losses. Selling that stock at $100 felt good, a concrete win. Holding on while it went to $200 involved the risk of it dropping back down, and our brains are wired to avoid that potential pain, even if it means sacrificing potential gains.
So it's like cutting your losses short and letting your profits run. Juan. In reverse, I think I've definitely done this before. It's that instant gratification feeling, isn't it? You see the profit and you want to grab it.
Exactly. It plays right into our emotions. And that brings us to our first question for today. How can investors identify long-term growth potential and avoid being swayed by these short-term market fluctuations, Sam?
One key is understanding the underlying business. Is the company's growth sustainable? Are they innovative? Do they have a competitive advantage? This requires research beyond just looking at the stock price. Think of it like buying a house. You wouldn't just buy based on the curb appeal. You'd look at the foundation, the plumbing, the neighborhood. Similarly, evaluating a company's fundamentals provides a more objective view than just its current price.
So if I understand correctly, instead of reacting to the price going up, you should be looking at whether the reason the price is going up is sound. Like, if it's driven by real value creation as opposed to just market hype, then it might have more room to grow. This reminds me of what we discussed about fundamental analysis in episode 31, connected to the reference article's Part 3 on portfolio psychology.
Precisely. And that leads us to our second question. What strategies can help overcome the fear of missing out FOMO and allow for more disciplined investment decisions?
Having a clear investment strategy is crucial. Define your goals, your risk tolerance, and your time horizon. This acts like a roadmap, helping you make rational decisions even when the market gets turbulent or when you see others making seemingly quick profits. The reference article mentions this in Part 6, emphasizing emotional discipline.
A roadmap. I like that analogy. So if my goal is long-term growth, even if I see a stock double quickly, I should stick to my plan if the fundamentals still look good. It's about delaying gratification for potentially bigger gains later on, right?
Exactly. And remember, FOMO is amplified by social media and constant market access, as discussed in Part 4 of the article. So setting boundaries with those can be helpful too. So, key takeaways. Avoid getting swept up in the euphoria of short-term gains. Analyze the fundamentals and stick to your long-term strategy. Don't let FOMO dictate your decisions. For our listeners, the call to action is to research different valuation methods and develop a long-term investment strategy aligned with your goals.